The graphic of the yield curve over the last 2 years, I think, definitely tells a story. It tells a couple different stories, or makes a couple points. One, we highlighted maybe 6 to 9 months ago here on our videos that people were getting a little overly enthusiastic about the Fed cutting rates and what impact that might have on their borrowing costs, especially their mortgage rates. And we highlighted that the Fed controls the Fed funds rate, which is uber short term, and there's much less influence on the longer end of the yield curve, the 10-year and the 30-year Treasury. And the graphic that we're going to show really demonstrates that, because we've seen a massive move down in short-term rates from about 5.5 to 3 3/4 today. That's a 1 3/4% move, and you can see that on the longer end of the curve, there's been almost no movement. I know people are getting excited that the 10 years come down from 4.30 to closer to 4% now, which feels like a big move, but relative to what's happened in short rates, it hasn't really moved at all for 2 years. And what I think is interesting, and that lends into your question, is that there was so much money that was safely and happily earning mid-5s on their cash for a couple of years. That was sort of a nice couple of years for people that were holding cash and short-term cash alternatives, and that opportunity's kind of gone, and we highlighted that middle of the way through last year, and it does sort of coincide with this support or rally that we're seeing in defensive names, these boring but high-quality equities that have yield, as opposed to growth names which don't. It's almost as though you can visualize the money flowing out of short-term cash and into defensive equities to earn a similar yield. It's like yield-starved investors found a new home, and that could be what explains the discrepancy between growth and value stocks for the last 3 to 4 months.